Hey guys, and welcome to the Strategy Lab video. Today is the 25th of December 2019 and I want to give you a Christmas present. For those of you who celebrate Christmas today, this will be a Christmas present, and for those of you who don't celebrate Christmas today, this will be just a present. Okay, so what is this present? This present is the part of knowledge that may turn all your trading upside down. And this is a methodology of trade execution. Well, it doesn't actually matter how you identify your support resistance zones, how you identify your potential reversal zones, how you identify your pivot point zones, whatever you call them. Either you calculate them using moving averages or using harmonic patterns. I repeat, it doesn't matter. But the execution of your position, how you enter, is of great importance. I won't talk about this candlestick formation execution or limit order execution. No, I'm not talking about this. I will be talking about how you grow in your position. And I will explain how professional traders do this. Okay, for example, we have a support or resistance. In our case, it is a resistance if price is lower than that. And we need to execute 1000 lots, 1000 contracts. So we suppose that we are professionals that need to execute this. So how will you execute 1000 lots? So you will drop the 1000 sell limit order in the middle? No, professional traders don't do this. So what professional traders do? They do the following. In the beginning of the zone, they sell 100. If price does not reverse at once but goes deeper, they sell 2 more hundreds. You see this? If price goes even deeper, they sell 3 more hundreds. And if it goes even deeper, they sell 4 more hundreds. Yes. And of course they place stop loss at the outer side of this border. Okay, as you might have noticed, not only the higher price goes, you have the better entry. You are interested in selling. Yes, so your direction is this. The higher price goes, the better is your entry, but the larger is your position size, so your overall trading becomes more beneficial. And if we suppose that this is your take profit, just look at your risk to reward. So this was your initial risk to reward, yes? This is your second risk to reward, which is much better than the initial one, yes? And the position size is greater. So this is your third risk to reward, which is even better than the second one. And this is your risk to reward number 4, which is even better than all 3 previous ones. So of course, if you calculate 100 to 200 to 300 and plus 400, you will have 1000 lots. Okay, so this type of execution, this gradual execution, is called netting. And the majority of brokers, they simply use the so-called netting account. So what they do, so suppose you opened 100, 200, 300 and 400. So you, instead of having 4 positions, they unite these 4 into one position of 100 lot, and they give you an average price of that. As if you have only one position of 100 lot with only one price. So this is called averaging price. Other brokers call this FIFO, first in, first out. So suppose this position goes deeper, yes, to the level where you open your second position, yes. So your total amount of position is 300 lots. 300 lots is your total amount of your position. But because you entered here a bit earlier, here at that level, you have slight loss. For example, minus minus $200. Yes, this was your loss. So what an FIFO broker does, yes, it deletes this as if you never opened this, but you're at this level when you open 200 lots, yes, it calculates as if this was 300 lots, but because you have a loss, because you had a loss, your entry is not here. It is calculated the way to have that minus 200 already included into your position, so slightly lower than your actual position was. So this is called averaging the price, or first in first out, FIFO. So the first in was the first trade, of course, and when price reached the level when you open your second trade, your first trade is out. It is not actually closed, but it is added to the total position amount, and your price becomes slightly lower because the loss of your first position is included into your second position. Okay. Well, you may be heard about this methodology as a hedging account. Some traders say that it is a hedging method of accounting, calculating the positions. Netting account, FIFO account, average price account, and so on and so forth. Okay, so if professional traders execute their trades this way, why not to execute them for other traders? Why other traders are executing only one trade? Why not to use these benefits, this trick that professional traders use? Okay, so I created a special strategy for that, and as a means of support resistance calculation, I will be using patterns. So let me go to daily and let me draw some patterns. So I decided them to be this way. It is arbitrary, it is not exactly the best ones. So I suppose the B point be minimum 0.3 to 0.7 and the C point be minimum 0.3, maximal 0.1. The entry is 0.7 and the stop loss 0.2. So why is it so? Just it is a common sense. So we have a pattern. This is 0.7 somewhere here, which is actually 70% retracement. Yes, and here we have 1.2 somewhere here, which is actually 120% retracement. So this is all compared to X. And because price, when we are looking at this retest, yes, it is what we are looking here, we are looking at the X point retest. All these patterns are retesting patterns. So the retest may start from 70%, 80%, 90%, yes, and it may go further, 100, 110, and 120. So this zone is wider because statistically reversal takes place before touching the X point than after touching this. That's why the zone is wider. I made it wider. Okay, what else? Well, nothing else. The time frame for that, based on my calculations, this methodology doesn't matter what time frame you have. Netting, accounting, netting, trading, doesn't matter what time frame you have. But overall strategies, when you create some strategy, you should keep in mind that what works on daily won't work on intraday time frames. Those who say otherwise are simply misleading you, and they are they have some purposes to misguide you. So just imagine the situation. What is the daily time frame? So suppose we have cycles on daily time frames. So they are winter, spring, summer, autumn, winter, spring, summer, autumn, and we have these cycles. Yes, they are slow, they are steady, and so on and so forth. And what we have on intraday time frame, let's say 30 minutes, yes, we have Asian session, which is almost dead, yes, Then we have London session, which typically gives us some trend, and then we have American session, which actually gives us some news, breaking to the upside, to the downside with different directions, in different directions. And then again, it all dies during Asian session. Then we have some, let's say, downtrend in London session, and then we have some upside downside breaking in American session. So if you will compare this picture and this picture, what are the similarities? Why the heck the strategy that works here should work here? How can this be? So I know only one reason why people say that what works on this time frame works on every time frame. It doesn't matter, because there are different traders. Some traders are trading dailies, others trading 30 minutes, 5 minutes, and whatever time frames. Yes, and if you wanna get larger auditory, yes, larger audience, you should include everybody. You should involve everybody into your methodology, and this is only beneficial if you are teaching something. The larger is your audience. If you say that your trading methodologies only works for daily, you will never have users, you will never have students that trade less time frames, smaller time frames. You will never have them. That's why you will have less sales, less selling of your products. But if you say that it works on all pairs and all time frames, then you will have a large audience. Okay, but in reality, you just don't believe it. Use your common sense. Does this sinusoid daily time frame movement coincide or anyhow resemble this intraday movement? Of course, no. Okay, so what works on daily not necessarily works on what is it? Not necessarily working on intraday. I did some filtering. I created a special robot that will be placing this netting trades based on MPS patterns. The robot itself does not draw any patterns. It simply executes trades. It's not needed to draw, and it does this absolutely automatically. And I did some testing, and because of filtering, yes, it filters this stuff, yes, this stuff, and it only exploits these periods because of that filtering. Not price should be moving in some channels. Okay, these periods, they resemble daily movements better. Sometimes these periods resemble daily movements as well, because daily may move this way in some channels. So those traditional technical analysis stuff like channels, trend lines, moving averages, they work on daily and they never work on intraday. They were created for daily, like RSI, MACD indicators, and so on and so forth. They were created for daily prices, not for intraday. Okay, as I told you, I created some robot that trades it this way, and I will show you the performance of it, how it works on history. I also attached that robot to my Eurodollar 30-minute time frame, and it is working real time on my demo account. And if it shows good results like this, then I will simply start copying trades from my demo to my real account, as I do it usually. Well, that's it. This is the intro. Now let me explain you the idea itself, and let me explain you the methodology itself. So the first thing that you need to do, you need to prepare your Fibonacci. So the Fibonacci should have the following levels. Let's go to properties, go to Fib levels, and here you should have level 0, level 1, then you should have level that is 1/3, 0.333. Then you should have level 0.25, 0.5, and 0.75. So they are 25% steps. Okay, percent dollar means that it will display price. In MetaTrader 4 it will simply display price instead of the name. Okay, now we have everything that is needed, and for our backtesting purposes, let's prepare an Excel spreadsheet. So the Excel spreadsheet should look this way. You should have entry, direction, exit, lot size, and result. So the result should have the following formula. If this word is actually in Russian, but in English it is if the B2 is, which is a direction, the B2 equals bool, then do the following calculation. What are these calculations? Exit minus entry. So you can see it, exit minus entry. And if it is not bool, for example it is a bear, then entry minus exit, and then multiplied by 10,000. 10,000 is to have percentages. Okay, then we do calculation of our results. It is very simple. You multiply lot by your pips results, yes, and you multiply it by your tick value. A tick value for one standard lot, if you have a dollar account and your quoted currency, the second currency is dollar as well, then your tick value is 10. If your dollar currency is JPY or Canadian and you have dollar account, then for JPY it is approximately 9 and for Canadian it is approximately 7. You can find your tick value on your broker website, and if you are a programmer you just type a tick value to be displayed in comments. Okay. So this one is very simple, only euro dollar, nothing else. So if you have a dollar account and you have a euro dollar pair, this will be simply multiplied by 10. This means that every pip with one lot will give you $10. This is your tick value. Well, I think that's it. Preparation is done. Now let's do some backtesting. So let us arrange these things side by side, probably this way, and let's go to the beginning of the chart. Okay, so this is the first trade. Yes, we have a pattern, and the first thing that we need to do, we need to find out if it was a winner or a loser. So we stretch our fibs to find out our take profit, and we stretch it from C to D to completion. After the pattern completed, price went even further. You see it this way. We adjust our targets, and then we had this candle that actually hits 1/3. As I told you in the beginning, if price does not reverse immediately at the pattern completion level but goes deeper, yes, we may open second position, third position, and so on. So that's why we stretch our Fibonacci here to find out how many trades we opened here, like this. So you can see that this went to the downside, but it does not hit our second entry of 15.450. Obviously it doesn't touch that, so we only had one trade. Okay, now let us type down these data, these results, and let's have it in our in our Excel spreadsheet. Okay, pattern completion is our first entry, and it was 16.068. 16.086. Okay, direction was bull. Then the exit was 1/3, 16.55.9. And the lot size, let us suppose our lot size was 0.1. It is very easy to calculate when you have a lot size of 0.1 because your every pip will equal every dollar. So you see we had 47.3 pips and we actually generated $47.3. Okay, as this methodology is simple support and resistance trading, then what we typically have with support resistance trading is the following situation. So this is support, price bounce, then it bounces, then it bounces. So price may bounce again and again and again. So that's why we may enter it one more time. Let's do it this way. Let us enter this trade one more time. And let us suppose that we only enter our trades 2 times. We don't enter for the 3rd time. Why is it so? Why do we need these limitations? Only enter trades for 2 times. Because typically when you have this 1 bounce, 2nd bounce, and then you have a breakout. These are typical formations. 1, 2, 3, 4, 5 waves of LLs. That's why you do not enter for the 3rd time, even if price comes back to that. Okay, so let's examine what happened. Your 2nd trade starts from here, yes, then it goes deeper, then it goes to next candle which is deeper, and then it goes to next candle which is deeper, and your 1/3 is here. So from this candle to this candle was your 1/3 movement, and again it starts from the C point. Now let's calculate what were the entries. Your first entry was pattern completion. Your second entry was this line 15.45.0. Your third entry was this line 1.1480 and 8. And it didn't hit your level number 4, which is your maximal position size, but reversed. So we should type all these results. The pattern completion was 16.086. It coincides with the first one because it was the same. Your second position is 15.45.0, 1.15.45.0. Then your third position 1.14.80 and 8, 88. All these trades are bull trades, yes, and all of them have the same exit of 1.1585 1.1585. Control C, Control V, and here you have it. Now as for trading, the first trade was 0.1, the second trade was 0.2, and the third one was 0.3. So every time we were increasing it. So now have a look what you have with money. Your first trade was -23. Your second trade was 80, which is much greater than 23, and your third one was 300, which is greater than the second and the first. Okay, so here is how netting works. We did the second entry, second touch. We can also create some rules for this second touch if we think about a retracement. So with retracements, we should first have the movement that touches our level, and the second we should have, let's say, at least 2 candles. So these were bear candles, bear candles, bear candles. We should have at least 2 candles of opposite direction. So if we had these 2 candles, then we had a retracement. And if we didn't have two candles, then we didn't have a retracement. So let's see what happened here if we will switch to this. So we have only one white candle that hit take profit. So this is not considered to be a retracement, qualified retracement. But here we had two candles, 1 and 2. Now it is calculated as a valid retracement. That's why after this one we enter this one. So it is an additional confirmation that you need to enter for the second time if your first bounce was only one candle. Just an additional confirmation. Okay. Now let's go next. Obviously this didn't complete, and this one we violated the B point and we violated the C point. Did we violate the overall pattern? So let us see. If we draw the new C point and the new B point, we can see that the pattern was not violated. Okay, so let us find what was the minimal price. So after this bottom, we went to have this high, and it hit 1/3. So let us calculate. The high of the candle says 104.420, 04420, and this says 104.415. So this hit take profit. So if I increase that, this hits take profit. After this bull candle, you had that bear candle that spiked through take profit. But as I told you, this is not enough to be qualified. One candle is not enough to be qualified as a retracement. That's why we will enter for the second time when it completes. Okay, let us do it. Let us first split the zone to see how many trade executions we had. We only had one. Obviously, these candles does not reach our second entry. Okay, and let us start. So the first execution is 103.23.0, yes, and this was bull. And the exit was this candle spike, as I told you, 104.41.5. 104.41.5. Perfect. And the position size was 0.1. And as I told you, we only had one candle. That's why when it comes back to complete the pattern, yes, then we restretch that. We have a new low, and we have the same 103 entry, but the exit is a bit different. Now the exit is 104.33.5, and again this was 0.1 position size. So one pattern, two trades, both of them are winners. Okay, let's go next. This one didn't complete. Let me zoom it out. This pattern. So what about this one? Let us find first if it was a winner or a loser. So we stretch our fibs from here. Pattern completed here. Then it goes lower. This is not enough to hit 1/3. Then it goes lower and lower, and then it is enough to hit 1/3. So the first qualification for this is done. It hit 1/3. And the second qualification is that it should have several bull candles. So we have 1, 2, 3 candles in a row, which qualifies this as a retracement. So if we had a retracement, we do not enter for the second time. See the difference? Previously we only had one candle spikes, but now we have a retracement which consists of several candles, bull candles, and this time we do not enter for the second time. These simple rules, the so-called common sense rules. If you had a retracement, you enter. If you didn't have a retracement, you do not enter. Vice versa, if you didn't have a retracement, you enter, and if you did have a retracement, then you don't enter. 0.91 is the entry. 0.91008. This was bull. By the way, as price went deeper into this zone, so let us see, maybe we execute netting positions. And we do execute that. The first one is 91.08 and the second one is 89.940. 0.8994. And again, this was bull. Okay. Now, the exit for them all, for both positions, is 0.91761. So we type in 0.91761, and this one is the same. Okay, the first position is 0.1 and the second position is 0.2 because of netting orders. Well, so I hope you already understood all the nuances of this trading, all the rules of the methodology. Okay, now let us see what we have here. First of all, let us find if we had, if you have this trade as a winner or loser. This completed here, then we go here, and it went to the upside. So the first qualification that we had a retracement was met. And then the next one is that we should have two candles. So we have one and two candles. So this means that we do not enter for the second time because we already had a retracement. Okay, so next thing that we need to calculate was how many orders we had. And we only triggered one, we didn't reach the second, and then we had a retracement of 1/3. So that's enough. Only one trade, and this trade is the beginning of that 0.89793. This was a bull trade, and the exit for that was 1991.5. So typing it manually is a bit time consuming, time monotonous, especially for MPS users who already got used for lightning speed backtesting with MPS and FBU. Well, but for those who are not MPS users, maybe this is something that you actually do every day. So maybe this is not that time consuming for you. Okay, let us go to the next trade. And the next trade, this small pattern. So we first find if it was a winner or a loser. After touching this, it went to hit further than 1/3. Okay, but if we switch to candles, we will see that we only had one candle. So although this was a winner, we didn't have a true retracement. If we didn't have any true retracements, then we need to enter it for the second time until we have a true retracement. Okay, that's why we will record this trade as the first winner, 88.91. This was a bull trade, and the exit was 88.763. 0.8876.3. Okay, and this was 0.1. And let me copy the entry, Control C, because it will be the same for the second trade. And look what happened with the second situation, second position, second trade of the position. After hitting the first take profit, then it comes back and triggers the pattern one more time, then it goes deeper, triggers the second position, and then it goes even deeper, and it looks like it triggers the third one. So let us see the low: 87.25.0, 87.24.6. 25.0 is higher than 24.6. That's why we only had two positions here. And then we have this two bull candles, which is qualified as a good retracement. And the last thing that we need to do is to measure if this was a winning. And it was a winning because obviously it hits 1/3. Okay, so we calculated two entries only. One of them coincides with the pattern completion, and the second one is 87.71.5. Okay, so bull pattern, and the exit is this one, 1/3, which is 88.19, 88.96. And it the same for both. First trade is 0.1, second trade is 0.2. Okay. Let's go next for the second trade. Okay, obvious winner here. Now let's calculate what were the entry. So we had our entry number 1, and then we had our entry number 2 because of the second line. Entry number 2, 88.25.9. So let's type the entry number 1. 88.88.2, this is the pattern completion, and then goes 88.25.9. So this is the second trade. They are all bull trades, and the exit is the same for all trading positions. It is 89.18.0. Oh, sorry, 89.49.2, 1/3. The first trade is 0.1 and the second trade is 0.2. Okay. Now let's go for the next trade, next bull trade. We had some bounce, and this bounce should be qualified as good retracement because it has more than two bull candles, 1 and 2. Not necessarily that these bull candles should be consecutive ones, one by one, side by side, but enough to have two of them. So as for entries, we had entry number 1, entry number 2, and then we had that retracement. And as for this size of this retracement, it was enough to hit take profit. Okay, so let's do it. First we type this completion, 0.89773. So the second is 0.8937. Yes, so they are all bull and bull and bull. And now we stretch the exit, and the exit of 1/3 was 89.93.2. Exit is the same for both positions. As you can see, majority of positions are 0.1, 0.2, 0.1, 0.2. Rarely it goes to 0.3. So this means that the reversal starts immediately. In majority of cases, it starts immediately. And the deeper it goes into the zone, the seldom this happens when a reversal starts from the deeper side of the zone. Okay, now we have a bear pattern, and I think this will be enough if we simply calculate that bear pattern. We had bull trades, and now we have one bear trade. So as for this bearish trade, what we have? We had this first execution, yes, and then we had the second execution. So let us type it this way. 0.0052, and then our second is 0.90534. So this time they are bear patterns, and what was the entry? And the entry was 921. 0.921. The same for all. So we have 0.1 and then we have 0.2. Obviously we had bearish candles here, so this is qualified as a good retracement. That's why we do not re-enter that after we hit take profit. Okay, now we have some bull pattern, one more bull pattern, and this will be enough, I suppose, yes, with small retracement. So we had entry number 1, entry number 2, and let's qualify if it was a winner or a loser. So let me delete this and let me zoom it in. So you can see that after this candle we go to hit 1/3, yes, but this 1/3 we didn't have any white candles, so this is not qualified as a good retracement. So this means that we should re-enter it back next time, but first we should calculate this as a winner. So how do we calculate this? We only had one trade, I suppose, yes. Let me delete it. So at this candle, which was the lowest before it hit 1/3, the second level was not hit, so we only had one trade. So the trade was a pattern completion, 88.39.4, and this was a bull trade, and the exit was 1/3 at 88.53 and 3. Position size was 0.1. Okay, but then price reversed and installed a new bottom, yes. Okay, so in this case we do the following. In this case we enter at pattern completion, and then we enter at the second trade. So the pattern completion was this, the same, and the second trade is 0.87895, and again we had a bull trade, and the entry here is different. Exit, which starts with this bull candle and hits our 1/3. So we have 0.8847. 0.8847 3. this time we had two positions, one of them 0.1 and 0.2, two trades in one position. Okay, I think that's enough for understanding the whole approach. Of course, you can only execute one trade, I mean when it reverses without qualifications of retracement, but I like to qualify it as a good retracement. Was this retracement good? Should I re-enter the pattern or should not? They are my own rules based on my experience. So what we have so far, starting from 500 account, we multiplied 1, 2, 3, 4, 6 times, multiplied this account 6 times, and 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 trades. 13 trades and you multiply it 6 times. Not bad. You don't need to execute all those million trades. As Jesse Lermo says in his book Reminiscences of Stock Operators, there are ordinary fools that do wrong things all the time, and there are Wall Street fools that think that they need to trade all the time. So you don't need to trade all the time. As you can see, 13 trades, 13 patterns. You have more trades, of course, 22 trades. 22 trades, multiply your account 6 times. Not bad, not bad. Okay, as I told you, I created the robot to do that automatically, and this is very beneficial when I need to test 30-minute time frames. Of course, on daily time frame we have a small amount of trades, yes, so it is 2001, 2002, we already tested 3 years and we found 22 trades. But if you test 30-minute time frames, you have much more candles, and there are thousands of trades, tens of thousands of trades. 30,000 trades is the average. So here how it looks like. Let me show you settings. Practice period is 5. As I told you in the beginning, it doesn't draw the patterns themselves. No need to draw pattern because it executes that. So there are some money management stuff. Maximum number of trades, 10 trades, and there are some filters to filter those things. Also, I coded the filter of qualified retracement. If it is a good retracement, then if all criteria of retracement is met, then you do not re-enter. But if you don't have all criteria of retracement met, then you have a second entry with this same pattern. Sometimes you have 2 trades, but not more than 2. The third trade you don't enter. What else? The rest is the same, actually the same. Although the daily time frame and 1 hour time frame, they are different. I also added some ATR range filter to find these episodes. So you see this when daily moves, we have channels, yes, and also when Asian session moves, we also have channels. Before we have these breakouts of London and insane behavior of New York sessions. So sometimes we have London sessions also moving channels, not only Asian session. So I use an ATR filter that shows me that price is channeling. Sometimes we also have New York sessions with channels, but the channels are bigger. Okay, but what else? Well, maybe that's it. Maybe that's it. And I also created the money management. So if I start from $500 account, like this, $500 account back in what is the starting date, 1999, the first date of my backtest. And if I double this account, then I double my position size and I double my increment step. So my positions will be, if they were 0.1, 0.2, 0.3 with 500 account, then there will be 0.2, 0.4, 0.8 if I double my account. So double account, double positions. Very simple money management. What else? As you see, the not needed every tick mode. It is seen if the high touches the line that the trade was executed. You don't need every ticks for that. There are not many trades that I executed several times per 1 second. There are robots that do that execution, 100 trades per 1 second. Of course, I don't need that every tick mode. So control points is enough for me for backtest. Now, let us see. Just choose this euro dollar, the one that I shown you with daily, and because of those filters that filter that insane news and blah 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 stuff, we have the price and account behavior moving this way. So you see it quickly enough, it rises the account to maximal position size, and because of broker limitation, 100 lot is the maximal position size that is allowed by my broker. This becomes straight. If we're not for that limitation, it will become parabolic, and it will go further and further and further. So let's go to this report. 76% of winning trades, and relative drawdown is 27%. So I like relative drawdown because it is much better than maximal drawdown. Maximal drawdown is calculated in money. If I have a larger account, my maximal drawdown is larger, of course. But in percentages, it doesn't show me the true value. But the true value is relative drawdown. So the relative drawdown was 27%. Luckily, it happened in the beginning of my, let's say, career. Yes. So let's say this was 30% drawdown, and I have lost $300, 1/3. So it happened when my account was $900. Yes, $900 minus 300, and that was the result, 27%. What else? How much money generated? $146 million, starting from 500. Because trading 30-minute time frame, executing that again and again and again, 38,000 trades. This is not daily, of course. 30-minute is a bit more often, but 30-minute is a bit different from daily. On daily you can execute trades without any filters, but on 30-minute you cannot do this. You need some filters because there are different sessions, different price action behaviors, as I told you in the beginning. And as for other pairs, it works as well. So let's say Australian, maybe Australian. Oh, okay, let it be dollar Canadian. As you can see, it is again generates enough money to open maximal lot size positions. And the results are pretty much the same, 77%, different pairs, but the same 77%. And if we will go, I don't know what, Australian dollar, again it will be about 77%, 76, 77%. So it is rising and it is moving to the highs, then it reaches the maximal possible position size. Generating lots of money. So pretty promising result. Again, 74, almost 75 position size, but the relative drawdown was greater. It happened in the very beginning, again 62%, and 2/3 probably the account was somewhere less than $1,000. That's why it was greater. But the maximal drawdown, of course, is 4%. What else? Maybe you are interested in dollar yen. Same stuff. Again, graph is rising, blah blah blah, and the numbers are identical. So I love those patterns that work identically on all pairs. Maybe some statistical error, plus minus 0.5%. This makes it more reliable than when it works on one pair and it doesn't work on other pairs. So almost 75%. And maximal drawdown is 3%, 3.5. And again, 127 million generated. Well, that's it about intraday trading of this methodology, and daily was shown manually. So I hope that you like it. If so, leave your comments below this video if you find it useful. Once again, Merry Christmas to all of you who celebrate Christmas today, and don't forget to click that bell, subscribe, thumbs up, and share this video on social media. Goodbye.